problem 5, which is exercise 13.6 in your text, is kind of the quintessential managerial accounting problem. You're looking at purchasing a piece of equipment, capital budgeting decision, and trying to decide whether you want to do it or not. Good idea, bad idea. Unlike the problem we did earlier, where we're also putting value on intangibles, this company says, I just care about numbers. Tell me the numbers. So, it's a microbrew company, as opposed to PBR. You're considering the purchase of an automated bottling machine for $120,000. The machine would replace an old piece of equipment that costs $30,000 per year to operate. It says per year, so keep in mind that means it's an annuity. I don't know if that's important or not, but it might be. The new machine would cost $12,000 per year to operate. The old machine, currently in use, so it's still operating, is fully depreciated, net carrying value of 0, and could be sold now for a salvage value of $40,000. The new machine would have a useful life of 10 years, but at the end of 10 years, it's scrap. It has no value. So, given that, it asks us some questions. What is the annual depreciation of the machine? Jeopardy question, how much do you remember from accounting 1? The cost of the new machine is $120,000. It will last, 10 years? Useful life of 10 years. Therefore, the annual depreciation, 120 divided by 10, 12,000 per year, annual depreciation. Now, the annual incremental net operating income. This is the difference in operating income each year between if we kept the new machine, kept the old machine, or bought the new machine. This is the difference, the incremental net income. So the operating cost of the old machine is $30,000. So if we keep the old machine and just keep chugging along, it's $30,000 a year. The operating cost of the new machine is $12,000 per year. A lot of folks want to stop there and say $18,000. But you have to consider the depreciation on the new machine. Just as if we were still depreciating the old machine, which we are not, we would have to reduce that. We have to reduce the incremental operating income by the depreciation, because we certainly take depreciation expense, and that's $12,000. So the annual incremental net operating income is 30 minus 12 to operate the new machine, minus 12 the depreciation on the new machine. So the net incremental benefit of the new machine is $6,000 per year. Now the next thing it says is, what is the amount of the initial investment that should be used for calculating the rate of return? In other words, how much cash are we putting out now to consider the rate of return going forward? Because we want to consider the actual rate of return. So we need to take the cost of the new machine, which is $120,000, but where the hell is it? There it is. we have a $40,000 salvage value. So this machine's not costing us $120. It's really costing us $80. Consider it this way if you like. We're buying a new car for $120,000 and getting $40,000 for our trade-in. Our net cost is $80,000. Now, our simple rate of return is the incremental net income, and we worked that out earlier, and that was the $6,000. That was the incremental net income. Divided by our initial investment, which is $80,000. So our simple rate of return is 7.5%. In other words, if we buy this new machine, it will give us a 7.5% annual return.